Let's talk more about the company behind iconic brands like Crest, Pampers, Ivory, and others. We're talking about P&G. You just heard Scarlett mention the fact that it beat analyst estimates, including the ones from our next guest. He is, according to Bloomberg data, the most accurate analyst on P&G. Bill Chappell of SunTrust Robinson rates P&G shares a buy. Bill, the stock, as Scarlett pointed out, is rising in pre-market trading. I want you to try and identify for us what it is that investors like here, because it seems like a bit of a mixed bag. A slight miss on the top line, beat on the bottom line, compression in gross margins because of commodity costs, but a better outlook in terms of sales for fiscal 2011. So what is it that's the best thing about P&G?
You know, the single best thing about P&G this quarter is the volume growth, which was up 8%. And when you think about a almost $100 billion revenue business having volume up 8% worldwide, it's pretty impressive in this type of environment. I think the organic growth of up 4% was also better than what most people expected. On the total revenue, it was kind of in line or slightly below what people were expecting, but that all had to do with more adverse currency, and that's the tougher one to forecast when you're in so many countries, you know, how they end up playing with it on the top line.
Okay, so is that to say that we either trust P&G when they say that currency is only going to cost them 1 to 2% of sales next year, or do you wonder whether or not currency markets are going to make their earnings much more volatile?
No, I mean, you know, currency is a best guess. They don't do any hedging, so you have to kind of wait and see. And they actually raised their currency guidance. It is now expected to be a little bit better for the full year than previously expected, just because the dollar has weakened and they have still greater than 50% of their business in the U.S. But you know, it's still a variable. But that's why there's so much focus on volume growth and organic growth, with currency known it's going to be a variable from quarter to quarter.
Okay, now, Bill, here's an important question for you. As you point out, investors and analysts are focusing on volume growth. There is a good organic story there for P&G. But what about what we saw in gross margins? Commodity costs drove gross margins down some 70 basis points. You know, just on the surface, it seems like a significant issue.
Yeah, it is, but it's not a surprise, because it's not just commodities pushing down gross margin, it's also promotions. What P&G's really been trying to do over the past 6 to 9 months is build out its brand, re-energize the consumers to kind of pay up to buy what they're throwing out there. And that means trade promotions, which actually hurts gross margin, but it also drives volume. It's coupons, it's buy one, get one free, but it's driving that trial and driving that volume, and it still allows them to beat on the bottom line, so it works out okay.
Bill, what are we going to see from this company for the rest of 2011? They kept their guidance for earnings per share the same. They raised it for sales. Do you feel at this point, based on the volume growth that you saw today, that maybe that's a bit conservative?
Yeah, I do. I mean, they have much easier comparisons as we move to the first half of 2011 in terms of year-over-year volume, year-over-year trade promotions, and so I do expect it to expand. I think one of the reasons why the stock is up today is there was some investor sentiment that today P&G would actually lower their guidance. I think some thought it was unrealistic, and so by the quality of the numbers today makes people a lot more comfortable that they can actually do their numbers, which is why I think you're seeing the stock reacting this morning.
Bill, thanks for taking some time to talk with us about P&G. That's Bill Chappell of SunTrust Robinson. He is the best analyst on P&G, according to the data we crunch here at Bloomberg. Bill, thanks.